Okay. So it seems that you are not yet there, all of you. But let's say we can start now because time is running. So I just remind you where we are. So what was the last sessions? We had an introduction indeed about insurance. Just remind you that with the main elements for you to understand the basically the business model of an insurer. And remember, we made a big difference between life and non-life insurance. Non-life corresponds to casualty insurance and liability property insurance. Okay, and we're focused on that so far with the idea that it was a bit tricky for insurers to price the risk, okay, because you never know exactly how much it will cost if you take a risk and when the risk will materialize, so that it's difficult to handle and to price for insurers. This we have discussed, okay? And I told you that life insurance is a bit different for two reasons. First of all, because most of the most important business lines in insurance corresponds to a kind of saving type of policies, which looks like more like the saving plan you may have in a bank rather than to a non-life insurance policy, okay? And when you have life insurance in case of death, which is a bit different from the saving policies, well, it's more technically like non-life. However, probabilities are well known because we have a mortality table that tells us a lot about the chance of each of us to die within a year, and in case of the occurrence of the event, that is the death of a person, well, the amount to be paid by the insurer, the compensation, the claim, is known perfectly because it is stipulated in the policy, in the life insurance policy, in case of death, the amount that should be served to the beneficiaries. Okay, so technically, life insurance is really basically different from non-life. That's why it was necessary to have a specific focus on this. It's also important to have a specific focus on life insurance because, as you'll see, this is the growing domain. I told you that the insurance business should, in countries like yours, should progress rapidly in the years to come. This is particularly true for life insurance. So let's look at it. What are we going to talk about here? Excuse me, I'm just trying to find. Okay, here it is. Well, so what are we going to do? First of all, we're going to have a focus on demographic trend. Why? Because demographic trend will determine, we have a strong influence on the development of the life insurance business. And we'll see that particularly in a country like Vietnam, where the aging trend is particularly strong, well, we'll see that there is a lot to be done through life insurance and pension plans in particular to meet the demand, the growing demand for this type of product in your country. Well, so what type of product, what type of policies? So there are different types of life insurance policies. We'll see that together. Okay, and then I'm going to have a specific discussion on pension plans. Pension plans are, pension funds, as we call them, are different from life insurance companies. Nevertheless, it's in terms of activity, in terms of technique, it's very similar to a certain extent. Maybe there is a question of maturity. Pension funds invest with a much longer maturity usually, but still, it's the same type of technicity behind, and that's why it's interesting to make comments on that, because there are some technical elements which are important to look at, to have a clear understanding of what's going on in this field. Okay, so let's start with, let's forget about insurance for a moment, and let's start with the demographic trend, which is important to look at, because as I said, that's why we can assume that we will observe in the future a growing demand for life insurance products and services. Well, we'll start with a basic model which is used by economists to analyze the behavior of households in terms of saving and consumption. But we are indeed more interested in saving here. This is what we call the household life cycle. So let's take a graph to illustrate that. You know, on the horizontal axis, you will measure the age of the person. Let's look at the situation of a young couple that just got married. And well, the couple, we can expect good revenues for the future. So we can expect that the income will grow like this. You know, typically that would be people like you just got married, for some of you maybe. Okay, and you are looking at your future. You're going to have a bright future because yourself and your husband or wife, you know, you have a good degree, such as an MBF degree from CFVG, for instance, and then you can expect a growth of your future income. So let's assume a growth like this, okay? It means that if you start, you are young people here in your 30s, and then you will get older. And in the early phase, you can expect to have a rapid increase in your income, okay? So it means also that what we're talking about, saving and so on, concerns, let's say, at least middle-class people. Indeed, you would probably know some people, they are not just thinking of saving because they just have to think about tomorrow, whether they're going to have enough to survive, okay? So this applies to not only to mature countries, but at least to countries like yours, where there is a growing middle class, okay? Thinking of the future and with a capacity to save part of its income, okay? So what about consumption? Well, let's represent the evolution of consumption over years with this line like this. Well, in reality, I mean, this is a oversimplification because, you know, there are some period of your time, of your life where you consume much more and then you consume less and so on. But let's just, we don't need this complexity or this volatility on a short-term basis. Let's look at the trends. You know, we're looking at trends here, okay? So we can expect that consumption will grow together with the income, but you see that consumption is not growing as much as the income here. So what can we observe there? You know, you have a first phase, which is a borrowing phase. Usually young people, they tend to borrow money to get a decent place to live in with nice furniture. You want to borrow money because you feel that you need a car. So far you had a motorbike, but now you have kids maybe, and you want to have a car because it's safer and it's more comfortable and so on. So in the early phase of your life, you tend to borrow money because your income is not high enough to provide you with everything you feel you should have now. Okay. Well, why do you do that also? It's because you know that in the future you can expect a growing income and you know that you will have the capacity to repay the debt, okay? The bank also will bet on the fact that you have a potential, a capacity to generate income in the future, and that's why you can borrow money now, okay? Well, indeed, later on, you see that the consumption is lower than income, which means that you have entered then a saving phase, okay? Well, one day you will retire. Okay, you retire and you have a drop in your income because you are retired, you don't work anymore. So your revenue will come from essentially your pension, what you get as a retiree. And that's why indeed the discussion on pension funds and pension issues is so important. Okay, and you enter a third phase after the borrowing phase and the saving phase. You enter into a capital consumption phase, meaning that, as you can see, you are now consuming more than your income. Why can you do so? Because you have accumulated money during your saving phase, okay? And you have part of this money which you can draw regularly from your capital, just to bridge the gap between your level of current income and your level of consumption, okay? So So you see, the retirement age is really a very important limit to look at, because that's when you move from a saving phase to a capital consumption phase. Well, from this graph, we can infer a second one, where we can describe the net saving and the net debt, well, what we call usually the net financial position of the household. Okay? What happened during the early phase of your life cycle? You accumulate debt, because during all this phase, okay, you have a level of consumption which is higher than your income. Okay, so you have an accumulation of net debt. That's why you are below zero, in the negative area. Okay, and when you cross a line, when you start entering in the saving phase, well, you see, the very first impact will be on the reduction of your net debt. In other words, would you have your balance sheet? Okay, well, you might with your saving accumulate asset, but when you look at the net debt is debt minus assets. You know, so the first saving, even if you use this money to buy assets rather than repay your debt, you know, if you look at the net debt, well, you have a decrease like this. Okay, but you can see that during a certain period of time, you know, the saving is made through materialize in terms of reduction of your debt. I mean, you use your excess of income over your consumption to repay your debt. Okay, basically. Okay, and you are a real investor, a net investor, if I may say so. When you cross the zero line, you know, you enter then into an investment saving phase. That's where you have a surplus of your income over your consumption. Your net debt has moved down to zero. Okay, so most of your saving is used to buy assets, and that's where you start being an interesting person for a life insurer. Okay, or also for a bank willing to provide you with some possibilities of investing your money in specific instruments they would issue. Okay, saving accounts for banks, or life insurance policies, as we'll see later on, for insurance companies. Okay, what happened then later on when you retire? Well, you have invested partly because you know that later on you will need a bit of money to, let's say, as a complement to your retirement income. Okay, so you will then draw out of this capital. It's a capital consumption phase, and your let's say you will dissave. Okay, and your level of capital will decrease. Well, the day you die, you know, the day you die, if you die early enough, well, then your kids have a bit of money remaining, and they will benefit from that. Okay, but if you die too late, it's not represented here, but you could cross the line again and go below zero. You see, so the problem is that if you don't have enough, well, you know, if you die too late, which is a kind of risk, time risk. Okay, if you die too late, you could be short of money. Okay, which is one aspect that's for which life insurers will have to find a solution to provide you with. Okay, so you see these different phases of your life. So insurance starts being in the process when you enter the investment saving phase, because life insurers will provide you with solutions to build a capital that will be used later on to provide you with a complement to the basic pension you may benefit from the pension scheme that exists in your country. Okay, particularly if you consider that this basic pension scheme is not generous enough to allow you to get satisfaction through a level of consumption which is high enough to please you. Okay, well, so this solution indeed is what we're going to see later on. But you see that if you look at the country in particular, well, the demographic structure will have a strong impact on the demand for life insurance. If you have a country with very young people, you know, which is still the case in your country to a certain extent, well, these people are still, for many of them, in their consumption phase. That's why your economy is booming through consumption in particular. Okay, because you have so many, as we'll see later on, so many as a group, in this consumption phase. But when a large group of people will enter into investment saving phase, all of a sudden you may have a lot of people willing to invest, willing to save and invest in different assets. You understand that then this very strong and sudden demand for new assets may have an impact on the financial market and explain a kind of bubble. And certain bubbles which we have observed during the recent past, to a certain extent, is linked to the huge amount of saving arriving on the market, and the financial markets, and particularly due to demographic trend. Okay. What needs also to be considered in the day all these people, they cross the line again, they enter into their retirement period, where they will sell their assets. So you see, it's important to note that depending on the demographic structure of the country, you may be in a phase where consumption is really strong with a risk of inflation and so on, moving later on to a phase where a large group of people is willing to invest massively, and that might generate some difficulties and some bubbles on the financial markets. And at the opposite, if you move then further, this large group of people, okay, might then all of a sudden decide to consume, to sell their assets, which might have also an impact in the other way around on the financial market. That's why, it's important to look at this, and we are just going to look at that, particularly with a focus on Vietnam, with some numbers on a slide later on. I was just indicating that if you want to have an idea, it's usually around 45-50 that the population enter into the investment saving phase. If you make a simulation with interest rates and all that, well, you would reach a conclusion that it's around 45-50. I mean, the moment when people are entering into the investment phase. So let's look at numbers at the global level. These are data from the United Nations, okay, demographic data. So you see your country there, okay? So the population has grown rapidly since the early 50s, okay, to reach a situation right now which is around there, okay? As you can see, in most countries, except Sub-Saharan Africa, okay? I don't want to comment on this right now, but Africa is a very specific case, which is to a certain extent, which explains to a certain extent why Africa is not growing that fast right now, because when you have the population which is growing, it means that it's very difficult to increase your GDP per capita, okay? And usually a high level of natality rate usually corresponds to a rather low level of development, okay? But other countries, have grown rapidly, okay? And they have not yet, all of them entered into, let's say, mature phase, but you are fast moving, you are emerging countries, and you see that all of these will reach a maximum, okay, with a decline of their population for the decades to come. It's true in Central and Southern Asia, Eastern and Southeastern Asia, so Vietnam is included there. We'll see more precise figures for Vietnam later on. If you look at Europe, we are already old to a certain extent, okay? Europe and Northern America, you see, we have grown, but now it's flat, and it should not decrease, but it should not increase anymore, okay? Well, so if you look at globally, that's not quite interesting for our purpose right now, but just as an indication, you see that you are in the region which is, well, the largest proportion of the population in the world is located, with more than 50%. Even though Asia as a proportion has declined, and the only growing part, even in terms of proportion, as you can see, is of course Sub-Saharan Africa. Okay, and Europe and Northern America, the group of mature countries, let's say, as you can see, you should add Japan to that maybe, but you see it is already very low, okay, it should move even further down to around 10% of the world population. So just to say that Europe and the mature countries they are today, in terms of demography, are just close to nothing in terms of proportion, because you see 10% is not much. Okay, so what does it mean, this decline in population? It means that we are going to observe necessarily an aging trend. Why? Because if the population decline, it means that the natality rate is going down, you have less kids, okay? And at the same time, also people live longer. So in other words, the trend which we are observing now is a trend where you have a growing number of old people, okay, because they die later, because of all the progress which have been made in healthcare, and also a larger proportion of old people because there are less kids, you know. So if you look at this graph, which is quite interesting for our purpose, it represents the working age persons relative to the number of older persons in the population. Let's say that the older persons are roughly those who are retired, okay? So if you look at the case of, let's say to start with, the Europe and Northern America, the bottom line, the red bottom line, you see that if you look at 2020, okay, roughly the ratio is about 3. Okay, it means that you have 3 persons at work for 1 retiree. What's going to happen, let's say, if you look at 2050, which is only in 30 years from now, when you guys you retire, for instance, okay? You see that this will drop down to a ratio of 2, meaning that rather than 3 people working for 1 retiree, they're going to have 2 only working for 1 retiree. Okay, so the question is, can we make sure that those who are at work will produce enough wealth to maintain a good level of revenue for everyone, including for the retirees? Because, you know, the retirees, where do they get their money from? They are not working anymore, so they are not producing value anymore. So they need to count on the working people to produce enough value so that it can be shared between the whole population. Okay, indeed, those who are retired, usually they have been working when they were younger and they did contribute to that system. Okay, so it's fair. Okay, but you see that when you move from 3 people at work for 1 retiree to 2, there is a problem there which will need to be solved. We are going to discuss this indeed. Well, what about your region, you know, Eastern and Southeastern Asia, the blue curve? You see that in 2020, it's about 5 people at work for 1 retiree. So it's easy. It's easy to finance retirement and pensions. What's going to be the situation in 2050? You can observe on this curve that it's going to be the same situation as for mature country. You will be at around 2 people at work. 2 people at work for 1 retiree, whereas today you are about 5 people at work for 1 retiree. You can imagine that you need to think of it. And your politicians, I'm pretty sure they have this in mind, okay? And that's a problem to be solved for the decades to come. You know, it might be 2050, we are not that year, we are not yet there. No, but think of it. Okay, it's in 30 years from now. If you are 30 years old, it means you will be 60 just when you retire. Okay? So that's an issue for your generation, I would say. It has to be prepared. You cannot just wait until the moment where the situation is deteriorated. You need to handle that, and there are solutions. And among the solutions, indeed, there is a role to be fulfilled by insurance company, life insurance companies. That's why I wanted to show you these numbers, because behind that, you clearly understand that there is something that needs to be prepared, hence the important role of pension funds and life insurance companies. What about pension funding? So let's look at your country, Vietnam. This is an age pyramid. I guess you have seen that already in your life. You have the boys on the left with blue and the girls on the right side with pink colors. Okay, so for each age tranche, if you take the bottom line, for instance, you have about a bit less than 4 million young boys between 0 and 4, and it's just a bit less, but not much less, for the number of girls. Okay, well, and then if you move to 5, 9, and so on, for each tranche, you have the size of the population, male and female. Okay, so the retired population is there. Okay, so the workforce is there. You know, in Vietnam there is no problem, as you can see, for the retiree, because there are not many as a proportion of the working population. You guys are there. Okay, so now let's look at your future. What might be your age pyramid in 2050? Well, here it is. You see, now if you look at this age pyramid, you clearly understand the problem. Okay, the workforce is shrinking, and you see that the proportion of retired people, okay, is huge. So you guys, you are still friends, I mentioned here, okay, but what are you going to live with? Okay, so this is, just to show you that your country is among the, I wouldn't say the worst case scenario, but there is really something to be prepared for your future. Okay, when you look at these numbers, you can see that it's another way to illustrate the previous graph, where you had 5 people at work for 1 retiree. Well, you look at 2050, it may be maybe even less than 2 for 1. Okay, so how can you develop a system that will still guarantee that the pension scheme will be financed? Okay, so that's the challenge that countries like yours have to face. And indeed, if I'm insisting on that, I repeat, because life insurance company may have a role to play there. So let's look at the pension issue in general, because it's a discussion in most countries for the reason I've just mentioned, because of this aging trend, which is observed, I would say, in most countries in the world. Okay, so what you need to keep in mind, there is a discussion typically in countries like France, because there are two systems, one which we call the pay-as-you-go system, and the other one which we call a funded pension scheme. A funded pension scheme, let's start with this one, is a pension scheme where people would save money. Personally, you will save money, you will accumulate money through a pension scheme, okay? And later on, you will get your saving, which you will be able to use to consume when you retire. So you prepare through a saving, you prepare your own future to guarantee a certain level of income during your retirement phase. What is a pay-as-you-go system? A pay-as-you-go system is not based on saving. It is not based on saving. It is a kind of social transfer. That's a dominant system, for instance, in France, and you have it to a certain extent in Vietnam also. Well, the pay-as-you-go system, there is no saving. While I am working, okay, well, it's not a good example because I'm not working anymore, okay, except occasionally like here, okay, but while you are working, let's say, part of your income is taken from you and transferred to a retiree. So it's a transfer system. You work, and part of the value you create, rather than receiving it as an income, well, it's taken out of your income to be given, transferred to retirees. Okay? Well, indeed, while you do so, you accumulate right for your future. In other words, the day you retire, you will benefit from the system. Those who are working will transfer money to you. So you see, it's a transfer system, it's a social transfer, okay, from the working population to the retirees, but there is no saving involved there, okay, of very little, okay? So there is an argument which says that the pay-as-you-go system is not sustainable. Why? For reasons which we have seen before. If the number of people at work is shrinking, the proportion in comparison with the population of retirees, okay, well, it will be more and more difficult for people to take out of the value they create to transfer to retirees because there are too many retirees. Okay, so the aging trend will make this pay-as-you-go system unsustainable. Then the recommendation that some would bring or put forward to say, well, let's go through a funded scheme. If you save for yourself, okay, then you are sure that you're going to have money when you retire. Okay, so it's a kind of easy argumentation. The pay-as-you-go system is not sustainable because they will not have enough people at work to provide you with a pension. So save on your side for yourself. Okay. Well, I want to insist on one point. Whatever the system in place, okay, they're going to have a difficulty. They're going to have a problem, whether it's a pay-as-you-go system or a funded scheme. Why? Let's look at how it works. So you start with the working population. You have people at work and they generate value. They generate a global income, which is what we usually call the GDP, gross domestic product, okay, which is generated by the working population. Okay. On the other side, you have the pensions received by retirees. Okay. So what do you have in between? You have the pension system, all kind of institution, and also the financial market. So those who are working, what do? They know they have to think of their future when they get retired. So either they pay contributions as part of the pay-as-you-go system, they contribute to the system by providing contributions which will be served to the retirees, or if it's a funded scheme, well, they might decide to invest their money. They can do both. Usually, I mean, you have both systems in the countries. People contribute to a pay-as-you-go system, and they also, in addition, save money, which they will invest in a pension fund. Okay? When they do so, indeed, they acquire financial assets. They are building up a fund. Okay? So they are accumulating assets. It's part of their wealth. They also accumulate rights, because when you contribute as part of the pay-as-you-go system, you are accumulating rights which will be exercised later on when you retire. Understand well? In a pay-as-you-go system, you transfer money to the others, to those who are retirees, but by doing so, you accumulate rights and you will benefit later on. It will be your turn when you retire. Okay? So either you accumulate rights through a pay-as-you-go system, or you accumulate financial assets through funded pension funds. Okay? So if you look at the other side of the graph, what do you have? Well, the retirees, they receive pensions, they receive financial contributions, either because they claim their rights, okay, or because they sell assets. So the sale of assets which they have accumulated first, or the exercise of their pension rights accumulated through the pay-as-you-go system, well, that's the way they can get the fund they need for their pensions. So you see, whatever the system, okay, if there is a demographic trend, which is an aging trend, as we have seen, there is a difficulty. Why? It's obvious for the pay-as-you-go system. If there are less people working, it will be more and more difficult to organize this transfer to the many retirees. Okay, but can you get a guarantee through the accumulation, a personal accumulation of assets? It's not sure at all. Why? Because how can you get your money? You need to sell your assets to get the money you need when you are retired. But if there are many people retired, many people will sell. And if many people sell at the same time, what happens? The value of your assets will decrease. So you see, if there is no economic growth, if the GDP is not growing enough, okay, well, it means that if there are many people selling their assets, they will not have enough revenue to buy, okay? And if there is nobody or not enough people willing to buy, when a lot of people want to sell, the result is a decrease in the value of assets so that you don't receive as much as you did expect in the first place. Okay, so whatever the system in place, a pay-as-you-go or a funded scheme, okay, an increase in the proportion of retirees put a strain on the system. Okay, so what are the solutions we can think of? First of all, one solution is a later retirement. I don't remember at which age you retire in Vietnam, but I think you retire very early. It's around 60, okay? If I remember well, maybe less than that. So one way to solve the problem is to say, well, rather than retiring at 60, you will retire at 65, okay? In this case, you increase the proportion of working people, and you decrease the proportion of retirees. So that would contribute to solve the system, okay? Another way around is to increase contribution. You can ask working people to contribute more, or they may have to make an effort and invest more and save more of their money to consume less, okay? The problem there is may not be good for the economy, but also an increase in contribution working people will suffer. They probably will not be quite happy. You know, that's why politicians have difficulties to deal with that. Okay, because if you want to propose as a politician, well, you know, I'm going to be elected and I will solve that pension problem. So I will ask you to retire later and to contribute more. You are not elected if you propose this, even though it would be a good solution technically. Okay, you know, politically, politicians are not comfortable with that because it's not what people want, you know. Well, the other way around is politically not easy to implement either. Okay, neither. Lower pensions. So if people retire later, if they have lower pensions, and if the working people contribute more, this is technically the solutions that can be implemented. But politically, very difficult for politicians to decide. Okay, basically, what is the most important point? Okay, increasing the participation rate. Participation rate means the proportion of people at work in a country, one way or another. Education to reduce unemployment, for instance. Maybe to ask people to work a bit longer because due to healthcare progress, you know, people live longer in more comfortable ways. So it seems reasonable to ask people to work a bit longer. If you take the case of a country like Germany, for instance, now they have decided that people should work up to 70. Okay, and in Europe, where the aging trend is strong, well, the population is aging rapidly now. Well, this is a decision which has been made in many parts of Europe. Okay, so increasing the participation rate, obviously, but the key element, the most important point, is increase labor productivity. What is labor productivity? It is a GDP per hour worked, okay, or per person employed, if you prefer. Okay, so since there are less people at work, the priority should be to develop new technologies to make sure that each person at work will produce more. You know, if you can produce as much as 2 people today, thanks to a new technology with 1 person only, then you can solve the problem this way. So increasing productivity and labor productivity through robots and new technologies, artificial intelligence and the like. That's why digitalization is so important today. You know, if we can, with much less people, produce more, then we solve the problem. So that's where the priority should be placed, and most politicians have well understood this indeed. Okay, so productivity is the key solution, the most important point to look at when you tackle this aging issue. Okay, so I hope at least at this level you have a clear understanding of the problem behind the aging trend concerning the pension issue. Okay, well, so now, based on this, I will just comment a last graph, the last table with numbers, just to show you also that indeed, you consider that it may not apply to Vietnam, but it may apply to Vietnam, what I'm showing now, rather rapidly, because you are growing fast, okay? But when we talk about growth today, okay? In growth is the solution always, because if you grow, you have more GDP. If you have more GDP, okay, then there is more money to be distributed. So it contributes to solve the pension issue, okay? And we said that growth might come from productivity increase, indeed, because if each person at work produces more, it contributes to growth, or the increase in population, but we have seen that this is not the case. Population is decreasing, so we can just try to compensate with higher productivity. But it means also that, the question is, even if you improve productivity reasonably, what will be the impact on long-term growth rate? In a country like yours, you are used to 5%, at least 6%. We used to have 5% growth during the 60s in Europe, okay? And now in most countries, growth, in mature country is more like 1.5, 2% rather than 5 and 6. Some people consider that, well, we will come back to rapid growth as usual later on. Well, but also some economists are considering that we are entering into an era of what we call secular stagnation. There are good reasons to believe that for mature countries, when you reach a mature or close to the mature situation for an economy, well, it is more reasonable to consider that growing at 1 or 2% is a kind of normal situation. So why am I saying this? Let's look at this simulation. Here, to start with, I'm assuming a closed economy. So let's look at the first column. The first column, we have number for year T. It could be now, it could be 2022. And I'm looking in the second column, a year T plus 40. So would T be 2022, then T plus 40 would be 2062. Let's take a country with a GDP in billions of 2000. Okay. What about population? Let's take 100 million. Okay. Now let's look at the demographic structure. Let's assume that you have over 64, let's call them the retirees, 20% of the population. Then the working population between 15 and 64. Why 16, 54? Because in international data, usually this is how the working population is defined. And let's assume that it would represent year T, 65%. Now the young people, they are there, but they are not working, 15%. So you have a dependency ratio, which is the number of working people, L over R, which is to start with 325, which would be roughly the situation we have in Europe. Okay, so the GDP per capita would be 20,000. Okay, because you see we have 2,000 billions and you have 100 million people, so GDP per capita is 20,000. What is the level of productivity? Okay, the level of productivity per person at work, GDP per person at work. Okay, you see your T, the GDP is 2,000 billion. Okay, how many people are at work? 65% of 100 million, that is 65 million. If you take 2,000 over 65, you find 13,769, which is the GDP per person at work, which is a kind of measure of gross measure, let's say, of productivity. Let's assume that in this country, the pension transfer as a percent of GDP would be 12%. It means that the income per capita for retirees would be 12,000. Okay, 12,000. Because why? Because you have 20% of people retired. Okay, so they would get, if you take 12% of that, of the GDP, and you divide by the 20 million retirees, then you find 12,000 for the income per capita for retirees, which is transferred to them through the pension schemes. Okay, so that's where we are. year T. What about year T plus 40? Let's forget about the GDP per, let's forget the first line because it has been calculated and I will tell you where it comes from. So let's assume that population is stable, 200 million. But there is a change in the demographic structure. So the change is that the proportion of retirees has increased because of the aging trend which we have described before. And let's assume that retirees now represent 30%. And that would be at the detriment of the working population. This is also a kind of observation which we can make. Here, I've assumed for the sake of simplicity that the number of young people would be still 15%. So we could have a bit less and a bit more of working people. Let's take that as it is, which is rather realistic, by the way. So now you see that the dependency ratio, I've moved down to 183, which is in line with the data, roughly the data I've shown you, okay? So now let's consider the line productivity, okay? So productivity, now we can make an assumption. You know, I told you that productivity was the key element because the productivity corresponds to what is produced by each worker. So if you can increase this, you partly solve the problem, okay? So here I have assumed that productivity would grow year after year at 1.5%, okay? So here, this is an assumption I have made, you know, and this is a reasonable assumption. If you take long-term data, if you take historical data, you know, even though we may have much more important growth in productivity in few years, for the few years to come, because, for instance, of digitalization and all these technologies coming up, okay? But if you have a long-term perspective, you cannot assume a big rate. 1.5% is seen as a very reasonable guess, okay? So let's assume that productivity, GDP per person at work, would grow at 150% per year. So we start year T from 30,769. What if we apply 1.5% growth year after year during 40 years? Then we reach a GDP per person at work, which would be 55,816. Okay, so now that we have this, 55,000 per person at work, how many people are at work? 55 million. So we can, based on this, calculate the new GDP for T plus 40. It would be what is produced by each person, 55,816, time 55 million at work. And you get 3,070 billions. In other words, based on the assumption which we have made for the productivity growth, okay, due to new technologies and the like, and considering the aging trend, you see that we have moved from 2,000 to 3,070, which means if you calculate the annual growth rate over the 40 years of the GDP, you find 1.1%. This is the explanation why many economists would consider that you cannot expect a growth rate much higher than 2% for the decades to come, just because of this aging trend. So even though we might be able to increase productivity over years, okay, the fact that the population is aging and the number of people at work will decrease as a proportion, well, the increase in productivity would just compensate and a bit more the aging trend, so that we cannot expect a high growth rate for the future. Okay, so this is the argument. Indeed, in this context, you see the importance for people to get prepared for their retirement age, because they cannot expect so much on growth, I mean, to provide the easy solution. Productivity is key, as we've seen, but, you know, it will just compensate the aging trend. Okay, so if we consider a global economy where international movements of labor, goods, and capital are free, indeed, the solution might be a bit different, okay, because some countries could benefit from workers from outside, which is typically the case of a country like Germany, for instance, in Europe, because Germany is a very old country in terms of age structure. You have a lot of retiree, okay, and the Germans are really welcoming refugees, for instance. Why? Because they see that as an increase in their working population that will contribute to economic growth, okay? That's a big difference, for instance. It's interesting to compare Germany and Japan. Germany is accepting refugees. They are open to new people, either coming from Ukraine right now, for the reason you know well. Okay, but they also have accepted a lot of Turkish people coming in, or even European people from Spain, from Italy, moving to Germany. Okay, but okay, if you take the case of Japan, you know that the Japanese have never been keen in their history to accept foreigners. Okay, and therefore they suffer a lot, and it explains to a certain extent the very slow growth you observe in Japan for years now. Okay, the fact that they are very close in terms of population. Okay, well, so now, having said that, it was just as an introduction for life insurance to insist on the importance of life insurance in the years to come to provide solutions to this aging trend and the consequences in terms of pension and retirement. You know, if you want to get prepared for your retirement age phase, actually, you want to make sure that you will have enough money to meet your expectation in terms of consumption and standard of living. Well, you understand that it's better to think of it right now. And where do you define solutions? Life insurance might be one aspect of the answer. Okay, so let's now focus on life insurance. What do they propose, insurers? So if you want to describe precisely the role of insurance companies, let's look at the life cycle of people. You know, they have an employment period, and one day they go out of the company, they say hello, and they enter into their retirement phase with a question mark at the end. You know, insurance has to deal with risk. What are the risks actually which are involved there? During the employment period, the risk has to do with the fact that, for instance, one member of the family might die. Let's assume you have a family with one person, kids, and one person at work, providing the revenue for the family. If this person dies, well, the family is short of money. So there is a risk of death. I mean, a risk of, let's say, for any event that would have an impact on the revenue of the household is an issue. Okay, so life insurance is there to cover that risk, to provide a kind of compensation in case the capacity of household to generate an income normally has disappeared, okay, or is damaged. So it may be because of a death of a person within the group, within the family. It may be because of health. You might not be able to work if you have a bad health condition. If you have an accident and a bodily injury, then you cannot work anymore, or at least during a period of time, and your revenue stream is interrupted. Or even unemployment. Unemployment can be seen as an economic accident. Okay, so you know, during the first period, life insurers will provide what we call personal protection. Okay, in case of death, health, bodily injury, or unemployment. Okay, and here in this domain, the type of policies are very similar to a certain extent to what we have seen in non-life. Why? Because there is a payment of a compensation if a certain event occurs, death, health, bodily injury, or whatever. Okay, so you can link the let's say the trigger of the payment to the occurrence of an event, and you know the probability of this event because you may have data about it. As I told you, nevertheless, it is easier to handle this type of insurance. Why? Because probabilities are usually better known. You have mortality table, for instance. We'll see that gives you a rather reliable assessment of the probability of the occurrence of a death, for instance, for a person, and so on. Okay, and would the accident occur, the event occur? Well, the amount to be paid, I mentioned that already, the amount to be paid, the compensation, is fixed in advance. So there is no ambiguity, okay, on the amount to be paid. And the probability of occurrence is rather well known. So technically, it's very similar to non-life insurance, but the difference is that you have a much more reliable data to price the risk in particular, okay? What's coming next? Here, the risk is, well, the risk is not to know whether you're going to die or not. We all know that we are going to die, okay? Except on funny guys in the US who believe that they will be able to keep alive for forever, okay? With all type of techniques and repairing their brain and repairing everything for you in your body. So, but let's forget about this. Let's assume that we can accept the idea that maybe we will die one day. The problem is that we don't know when. So the risk is not whether you're going to die or not. The risk is when. If you die early, you have no problem because, well, you will probably have enough money because you die early. But if you die too late, if you die too late, you may be short of resources. And that's not comfortable, People don't like to have this to handle, okay? So for the other part of life, the risk is longevity. It's related to the fact that you don't know exactly when you're going to die, okay? And you have a risk of insufficient resources if you die too late, okay? So what are the solutions? Different type of policies, which will be retirement, focusing on retirement, or pension plans are also solutions. Okay, so these are totally different type of policies, and we will look at each progressively, step by step. Okay. Now let's look at. I told you that having seen now what was the scope of life insurance, I told you that in a country like Vietnam, obviously, the life insurance business should grow very rapidly. Because, as you can see, it is linked to demographic issues. Particularly, the people tend to live longer because of better health conditions, okay? And therefore, when you look at the retirement issue and the pension issue, because of aging, as we've seen, and particularly in Vietnam, well, there is an issue to be solved there. So, indeed, solutions can be provided by insurance company, and then you can expect that they will grow rapidly. If you look at your country, well, just to detail, there are different market segments. Before I move to the next slide, insurance can be an individual insurance. You can go to your insurer and negotiate with him, try to find the best solution for you. That's, you deal on an individual basis, but there is also group insurance, okay? For instance, you may benefit from a good policy, a good coverage provided by your company. So your company would act as a group representing all the employees of the company, okay? So this is a domain, a market segment, which we call group insurance. And particularly in life insurance, now most companies would provide together with, in addition to the wage and all type of advantages for their employees, they would include in these advantages possibility to have an access to, let's say, in good conditions to a retirement plan, a pension plan, and they would also usually contribute to this plan. Okay, so what about Vietnam? Life insurance in Vietnam. Making life insurance sexy. I found these T-shirts. I found it was funny, probably it's because people don't see insurance as a kind of sexy activity. So I thought it was funny to see that. So what can we say about Vietnam? Look at this number. That's a recent document. They look at the evolution between 2020 and 2025. Okay, and the estimate it's a number which seems to many specialists seems to agree on it. The annual growth rate exceeding 20%. So you see 20% year after year for the 5 years to come. So as you can see, that corresponds to the conclusions we had drawn before. Okay, so 20% is not a small number. Okay, now who are the players? I guess you know better than me, but I wanted to make sure that these are the major players with the market shares. See, so whether these companies will grow or whether new players will come in, it's very likely that newcomers might come in because of the strong activity of insurtech, as we call them. You know, there are all type of new companies which are emerging in the field of life insurance because you have understood that it was a very attractive field. So I would guess that in the future, I mean, the number of players will increase. Here you find a big name, but you know, you may have some disruptive entities coming in sooner or later. Okay. So I guess you know all these names, but it was just for your knowledge. So just to summarize, not so many players, okay, as of today. So this might increase. Why? Because when you look at 20% per year, okay, it means that in 5 years the market will more than double. Okay, because 20% during 5 years is more than 100%, as you know. So it's a rapid growth, which you can expect. And maybe you should think of it in terms of career for yourself, because when you see these numbers, well, obviously, a lot will have to be done in this field. Okay, so it was just this slide to convince you. Two important points to convince you. The aging issue in Vietnam. Remember the graph which I've shown you. Okay, I think it's good to remind it when you look at this. Okay, you see this block here, the massive proportion of retired people with a shrinking working class. Okay, and the consequence is that, you know, rapid growth, 20%, with few players today, but probably more in the years to come. Well, so now let's get into the detail of the different types of policies which exist. So I will just start with this table, which I think is provide you a good classification. Actually, there are many types of classifications and with more or less details. But here I provide you with the large, let's say, the main group of policies. Within each, indeed, you can find some differences. Each company would explain that they have something unique. Well, actually, whatever it is, it always comes in one of these four categories. Whole life insurance, term life. I will explain more precisely what it is with the next slides. The whole life would cover you, as it is indicated in the naming, for the rest of your life, you know, whereas term life is limited to a certain period of time. Okay. Endowment insurance is what I call sometimes a saving type insurance. Okay. You fix a date, and then at the end of when you reach that date, let's say the maturity of the policy, well, then you can get your money, which you have accumulated, and so on, or your beneficiary might get it. Okay, or you can get annuities. Annuities mean that rather than getting a certain amount of money at maturity, well, with which you could buy a house, for instance, or decide to give it to your kids and see if you have enough money. Well, annuities would correspond more to the retirement issue, because you say, well, rather than getting a certain amount of money now, I prefer to get a monthly payment that would contribute as a complement to my basic pension scheme. Okay, so these are the four categories. I will start with the two first one, which correspond more to the personal protection, whereas the two others, endowment insurance and annuities, would more correspond to the second part of your life cycle during the retirement phase, because as you can see, it's these are solutions which you can use to accumulate a certain amount of capital for having enough money when you retire. So let's start with the term life, okay, which is the basic type of life insurance. It's typically an insurance you would buy in case of death. If let me take a typical example. You have a household, a couple, one of them is working, okay? Sorry to say it this way, because we used to say, well, the man is going to work and the lady is staying home to take care of the kids, which indeed we shouldn't say today, because in Europe it will be not well received, because it would be seen as a kind of macho approach to the family concept. But let's assume that one is working, the other one is taking care of the kids at home. What if the one who is working dies? Well, it's a real problem for those who are staying at home with no money left, okay? So the term life would typically provide a guarantee, a coverage against this type of risk. So guarantee the payment of a lump sum benefit or an annuity. That is, either you get a certain amount of money in case of death, or you get an annuity, that is, the beneficiary, okay, will receive on a monthly or a quarterly basis, would receive a certain amount of money, okay, in the event of death prior to the term of the policy. So if it is usually a 1 year policy, which can be indeed renewed year after year. So how does it work? Here, I give you the type of data that can be used to price this type of insurance. This is the mortality table. It's a French one from the INSEE, is a National Institute for Statistics in Europe. Okay, this table is a bit old, but it doesn't change that much. Maybe I should renew my numbers, but anyway, it doesn't change so much. Okay, well, so in the first column you have the age. You start from 0, and then we could go much further down to 100 years and so on. So this is the age. Well, and then you look at the population. You start with 100,000 people, okay? So what do you read on line 25? If you reach 25, what do you see? The table shows you that you have only 98,332 left. In other words, it means that the difference between 100,000 and 98,332 corresponds to the number of people who died before 25. Okay? Then if you look at 26, you have 98,220, which means that, in other words, if you look at it, it means that 112 people died between 25 and 26. Based on this, you can calculate the probability of dying in the year to come when you are 25. Okay, so we can use this mortality table, which are rather stable, okay, to calculate the probability at any time, for any age, the probability to die in the year to come. Okay, so for instance, let's assume that the insured capital is 100,000 euros. In other words, in case of death, the insurer will pay 100,000 euros to the beneficiary. Let's assume a load factor, let's say an administrative factor, to pay for distribution costs and admin. Okay, this is a rather low factor because technically it doesn't cost much to produce this type of insurance. Okay, you can buy it online and so on. So the load factor is usually rather low. So now if you look at what would be the premium at different age. So when you are 25, if you want to buy this insurance, you see, you can read from the table the probability that you're going to die within a year. You can use the difference between 98,332 and 98,220, which showed that 112 people have died. Okay, so if you are 25, you have a probability of 0.1139% to die. So based on this, okay, you will calculate a premium, which will be actually the expected value. I should have written this somewhere, sorry, it's not written, but 120 is the expected value of payment for the insurer. That is the probability 0.1139% times 100,000 This is the expected payment for the insurer, okay? And you add 5% to this for the load factor. Would you do so? You find 120. Indeed, the older you are, the higher the probability for you to die, okay? So you see it would cost 170 when you reach 35. And then if you do it at 50, 622. And if you do it at 70, then 3,000, okay? So you see, if you look at the premium, you know, if you buy it early when you are young, it's cheap, but indeed, the older you are, well, the more expensive it is, because your probability of dying is indeed increasing, okay? So you see, it's a rather simple type of insurance. Very easy to calculate because the data are easily available. Well, you might just ask the question, but why should you buy a life insurance policy when you're 70? If your kids are grown up and they have their own job and they earn money, so you don't need to save money for them. You don't need to worry. Why should you do so? Okay. Nobody is expecting anything from you now because you're retired. Well, actually, there is a good reason. I don't know whether it's valid in Vietnam, but it would be valid in a country like France and in most mature countries. It means that when you die, you know, if you have a bit of money left, then it will be distributed to the kids and so on, and they may have to pay taxes on that. Okay, on inheritance, we have a tax in France, and it is true in most countries. So rather than receiving money that has been accumulated by the person who just died, let's assume that the money comes from the insurance contract, from an insurance policy. In other words, you receive 100,000 not because there was 100,000 saved in a bank by the person who died, but you receive 100,000 from the insurer because the person who died bought an insurance policy with you as a beneficiary. Then in this case, you would not be taxed on the 100,000. So, you know, if some people are buying this type of insurance, even when they are old, sometimes it is purely for tax reasons. Okay, so, but I don't know about Vietnam because I should look at the tax code, and I don't read. My Vietnamese is not good enough. I mean, to have access to this. There are lots of elements of taxation to be taken into consideration when you look at all these type of products. Okay. So now, what about whole life or universal life? Sometimes we say, which is the second category. It is still designed to meet the same type of risk, but now it provides a lifelong coverage, not just for 1 year. In other words, rather than renewing year after year your term policy, you can also define a contract that would be valid for the rest of your life until you die. Okay? The insured party normally pays a fixed premium until death. That is, you pay year after year a certain premium until you die, with exceptions, for instance, because you may decide, for instance, to pay premiums only during 20 years, okay, because after you decide not to pay anymore. In other words, the premiums during the first phase of the policy would be higher than what they would be if you pay regularly year after year until your death. Okay, it's a question of balance, and the insurer just make a calculation to see what would be the equivalent. Okay, so the insured party normally pays a fixed premium until death. Let's take this basic case. Well, it is a cash value life insurance. What do we mean by cash value? It means that you accumulate money year after year, because the money you pay, what you pay to the insurer year after year, is indeed invested. So your policy has a cash value. Year after year, the policy holder invests money with the insurer. At a point in time before termination, he may ask for the cash value or surrender value of his contract. If he can do so, indeed, as we'll see later on, probably the insurer will like to charge you a kind of penalty if you ask your money earlier than expected. Okay, but there is a possibility to get part of your money, to get back your money and the cash value of it, which corresponds to the total amount which has been accumulated, including the revenue you got from your invested funds. Okay. So if you compare to a term life, you see, the term life, you see the premium would grow like this because the older you are, the higher the risk for the insurer. So the whole life would kind of calculate a flat premium. Actually, it could be growing slowly, but let's assume the simple case with a flat premium year after year. You see, and the first phase is a provisioning phase for the insurer, which means that you pay less than what you would pay with a term life, okay? But the money is invested, okay? And later on, okay, you see that you are paying, excuse me, I was wrong in my explanation. During the first phase, it's provisioning because you pay more, indeed. That's what you would pay with a term life, okay? You pay more, but the gap is invested. So it's a provisioning phase, you know? There is a kind of excess of premium in comparison with the term life, which is used and invested by the insurer. So that later on, you know, you can maintain your premium, which become lower than what you would pay with a term life. Okay, so there is a kind of provisioning phase for the insurer, which will be there to compensate, to generate a surplus that will compensate for the negative gap for the insurer after you have crossed the line. Okay, so what is a universal life? It's a bit different, but it's the same type of category of life insurance. It's a flexible form of whole life, which lets you adjust benefits and premiums according to your needs. Rather than fixing a fixed premium, okay, you can decide to invest more or less year after year, okay? And then the insurer would make a calculation indeed to make all the adjustments, okay? So we call that universal life, okay? So these are the main life insurance that are there mostly to cover the risk of death, except that when you look at whole life, you start saving. It includes a portion of saving, as you can see, and also there is a cash value. So I would say that this is a transition towards the next type of life insurance policies we're going to see, which are technically much more focusing on saving. Okay? So saving or endowment life policies. That technically will be different, take a bit more time. So I'm just looking at my watch. It is now 2:20 for me, which means that it might be 8:20 for you if I'm right. Let's say. So what I suggest is maybe we could have we could now have a coffee break. I don't know what's your view on that, but I'm pretty sure that you would agree with me. Why don't we take a break? It's 10 minutes as usual. Okay. Okay. So see you in 15 minutes. Are you ready? Are you back? Okay. Okay, so let's come back to our slides. So if you remember well, you have two main categories in life insurance. You have what we might call pure life insurance, that is personal protection in case of death or in case of injury or health problems and so on. That is, I would say, the most simple part. Now we are moving to the other aspect, which is the pension aspect, or what we may call sometimes the saving life insurance policies, concerning the second phase of your life once you retire. I mean, when I say the second phase, is to prepare the second phase of your life after retirement to make sure that you have enough money to reach a level of consumption that is in line with your expectations. So it's a question of preparing the future, through a kind of saving instruments. And this is what insurance companies can also provide. Okay, sometimes it's difficult to see the difference between life insurance and banking. And to be frank with you, there is not much difference technically when you compare some saving instruments proposed by banks or saving instruments proposed by insurance companies. In the insurance case, you always have one aspect, which is the risk linked to the fact that there is uncertainty about the date of death. Okay, the end of your life, in other way. And you will always find one way or another this type of risk included in the policy so that you can say that it has to do with insurance. Okay, that's a legal aspect. But technically, and in terms of competition, banks and insurance companies are competing on this saving market. Well, and by the way, unsurprisingly, in most mature countries, the banks are leading on the life insurance market because they have a network which is much more appropriate to sell and to promote this type of policies. Well, so what is the typical structure of a saving type life insurance policy? First of all, you have three phases to consider. First of all, contribution. If you want to save money, okay, you will contribute either by paying premiums, and to a certain amount. It can vary from 1 month to the other, from 1 year to the other. It can be fixed. So how do you contribute? Okay, how do you feed the contract, if you prefer? Okay, then once the money which you have saved is in the hands of the insurer, how will it be managed? How will it be invested? That is the second component, which is asset management. And the third point is, how do you get your money back? It's the liquidity of the policy. And there are different ways to get your money back, as we'll see. So let's look at the detail of each of these phases. Contribution, it can be a single premium. For instance, you start a contract, a policy, you invest, you have a lump sum today, you don't know what to do with it. You have no immediate needs, and therefore you just look for an opportunity to invest this money. So you can say, well, let's assume you have 15,000 euros. You don't need it right now. You have your current income that is there to pay for your current consumptions. You have your equity. You don't need to spend the money now. So you say, well, let's invest this 15,000 euro as a single premium in an insurance policy. Okay, with a maturity, we'll see, 10 years, 15 years, or until the end of the life. It depends on the policy. Okay, or it can be a recurrent kind of contribution. That is, you may decide to pay on an annual basis. Each year, you will contribute for a certain amount. Okay, and it can be planned. Okay, it can be planned. That is, at fixed date, you have to contribute for a certain amount. Okay, but it can be flexible. In other words, you may start with a premium and then after 6 months had a bit of money, and then later on there is no absolute periodicity which is fixed. Okay, the amount is also flexible. So when you have a bit of saving, well, you can decide to invest this money on your contract, on your policy. Okay, indeed, obviously, the flexible situation, the flexible contribution is optimal. Why? Because if you have a flexible option, well, it means that you can decide to save the same amount year after year. So it includes the two previous solutions. So since the flexible contribution includes the two first solutions, people should choose flexible one because it includes the two first ones, so they have more possibility. Well, actually, it's not the case. The most frequent case is recurrence. Why? Because people want to make sure that they will contribute. Because if it's flexible, they may always, postpone the payment. They say, "Oh no, I'm not going to invest there because I need the money to spend here or there." With recurrent, it's a way to fix a kind of obligation to pay year after year, and then you secure your saving plan by creating an obligation to pay. Whereas if it is flexible, you may not invest enough because you will always find a good reason to use the money you have rather than investing it in your insurance company, in your insurance policy. Okay, but these are the three type of contribution that can exist. So no need to discuss more about it. It totally depends on the situation. Some people, single premium might make sense. Okay, if you have one lump sum available at a point in time, recurrent is very frequent because people like to save regularly. Okay, and the flexible amount might also be quite appropriate if you have a kind of income which vary from one year to the other, so that there are some years where you have more to save rather than some other years you may have less. Okay, well, so now the money is with the insurer. So you will have to decide on what type of asset management you want. Okay, and here there are also different possibilities. Either you just give the money to the insurer and you tell him, well, just do whatever you want. It's not my job to invest money. I don't know anything about the financial markets and so on. I wouldn't know what to choose. So I give it to you and you invest this. And I don't need to know where it is invested. So in this case, the funds will be invested in what we call the general asset of the life insurer. In other words, you contribute in the balance sheet. This contribution will contribute to increase the provisions of the insurer. Okay, because the insurer owns your money. Okay, so it's a liability for him. And this money will feed the general asset on the asset side of the balance sheet with no clear link between the money you have brought in and one particular asset that would be on the asset side. Okay, that's a difference with a unit link. Because the unit linked, you provide the insurer with a certain amount of money, and you ask this money to be invested in a specific sub-portfolio, if you like, in a unit, which is a particular fund, which is composed by the insurer and proposed to you, so that you say, well, I want my money to be invested in this fund, in this unit. Okay. In this case, the return you will get on your asset, on your investment in the life policy will depend on the performance of the unit. So if you are a risk lover, you will say, well, I want a unit with shares, because I know that shares, if it's a long-term investment, I know that shares overperform other assets, in the long term. So I want you to invest my money in a unit, in a fund made of shares, composed of shares essentially. Okay. And indeed, you should be ready to cope with the volatility of your return year after year, because when you invest in shares, you can expect a higher return in the long term, but you have to accept the short-term volatility. Well, if you are more risk averse, then you would say, well, let's invest in a unit that would be composed essentially of bonds, okay? Because I know that bonds are safer, and let's make sure that it's invested in state bonds from a very secure country so that I don't take risk with my money. Because I want to make sure that later on I get my money back with the return on it. So let's invest in these very safe funds. Okay, so you choose the unit, and when you choose that, you also choose implicitly the trade-off between risk and return. Okay, well, just if you invest in the general asset, well, what about the return? The return usually is a return which is guaranteed by the insurer. We would say, well, I'm not telling you exactly where I put it and so on. That's my job, but we can guarantee you a certain level of return. Okay. Well, so now it can be more complex because when you look at unit linked, it can be a single unit. I want this portfolio because there are shares in it, or it can be a multi-investment vehicle. That is, it may be a unit made of subunits. For instance, you can say, well, I want my money to be invested for 30% in shares. Within this 30%, maybe 10% should be foreign shares, a bit riskier, but more profitable, and the rest in public bonds. Okay, so you can, build your own portfolio of units so that you can have a more precise approach to the trade-off between risk and return. You can try to diversify, taking a bit of shares to boost the return, but also taking another proportion, another part of your money invested in bonds to secure your global portfolio, your global position. Okay. Well, when you are in a multi-investment vehicle, you can even have a more sophisticated policy because it can be fixed or flexible. Either you say, well, this is the proportions I want to have. Now you can indeed have a solution, and it's more and more common now to have investment in unit link, in multi-investment vehicle with a flexible option. That is, you can change. You can say, well, now I'm feeling that the stock market should be doing well in the years to come. So let's invest more in shares and less in bonds to boost my return. Okay. Indeed, each time you change, you have to take into consideration that you may have to pay fees, because you will ask the insurer to make transactions to move your money from one place to the other, and indeed, it's a good opportunity for insurance company to charge you fees. Okay. Well, so you see, there are lots of possibility for asset management. Again, you might ask the question, well, let's consider a person who is taking the unit-linked solution with a multi-investment vehicle and flexible. Then it means that this policyholder, will actually manage his money himself, because he's telling the insurer, I want you to invest this, this, and this, and this. So you are managing your own portfolio then. Okay, so why do you need an insurer? Because you do the job yourself in terms of portfolio management. Well, again, first of all, maybe the transactions are cheaper if you do it through the insurer, whereas you have fees, so this needs to be analyzed carefully. But also, again, and I don't want to get into the detail as far as this is concerned, but there might have tax reasons. Because if you invest in many countries, when you invest in life insurance, you have tax advantages. In other words, if you intervene on the stock market, for instance, if you invest your money through a life insurer, you will do it in better conditions from a tax point of view. Okay, and then it will indeed improve the performance of your investment. So that's why life insurance companies are many very attractive in some countries. It's essentially because of this specific taxation that exists in many countries. Now, if you want your money back, how can it be done? Liquidity. Well, you have actually three possibilities: a cash withdrawal, an annuity, or a capital. Cash withdrawal, let's start with this, means that let's assume that you have accumulated through your policy, let's say 30,000 euros, and you marry your daughter. as you know, it may cost you a lot of money for that. You say, so I would need to raise, let's say, 5,000 euros to help to pay for this event, which I didn't anticipate. I knew it would happen, but you never know when. Okay, so all of a sudden you would like to take 5,000 euro out of your insurance policy, out of your cash value, the cash value of your insurance policy. Okay, well, the problem is, if you want your money, you may have to interrupt your contract, and then you may lose money because you may have a penalty for early termination of your contract. So it's not always easy. So actually what can be done, rather than interrupting your policy, terminating it, and being sanctioned for that, okay, well, the practice is for the insurer to lend you money. Rather than taking money out of your policy, he would lend you the 5,000 you need, okay? You would pay an interest indeed, but this interest would be low because the insurer has a guarantee. He has the part of the contract, the 5,000, the contract is a kind of collateral that guarantee the insurer, which can lend you the amount of money you want. So rather than terminating your policy to get the money, well, you can benefit from a loan, okay, with your policy as a collateral. Okay, that's the most common practice if you need to have cash out of your policy. Indeed, you will pay interest on that, but you also have the amount of money which is still in your policy, which is also producing a return. Okay, so that's, you have a zero cost kind of. Well, if you reach the end of the policy when it terminates, because most policy have a maturity, okay, then you can decide to get a certain amount of money, a lump sum, which corresponds to the total amount you have accumulated. Then you get out of your policy with an amount of capital, okay? That may be the right thing to do if, for instance, you said, well, when I retire, let's say when I get 60, okay, then my contract will terminate and I will ask for my money back because I want to buy a house where I'm going to live for the rest of my life. Okay, in this case, it's the good solution is to take the amount of money and use it to acquire the house you want to have. Okay, the other way around is to say, no, I don't want this huge amount of money right now because I don't know what to do with it. I would have to invest it again. So why don't you keep it and serve me an annuity that is a monthly or a quarterly or an annual payment, okay, until the end of my life, so that, you know, the saving I have made, I want to transform it into an annuity which I will receive as a complement to my basic pension scheme, okay, as a complement until the end of my life. Indeed, if you die very early after your retirement, you're losing. But you know, some people will live much longer than expected and they would win. So that's the principle of insurance. You have the winners and the losers, if I may say so. But the insurer will play his role of insurer by providing insurers a guarantee of serving an annuity to a large population, knowing that some will die early, others will die later, but the insurer will make a calculation based on the life expectancy of each person. Okay? So this was the first stage to describe a typical or the different possibilities for life insurance policies and how these policies are structured. Well, so now let's go through illustration and few calculations for you to have a good understanding of all the technical aspects of life insurance. Okay. So now a first short exercise, which usually I ask you to do in class, but indeed right now we are going to do that together. Okay. Taking the point of view of the insurance company to look at the risk to which the life insurance company is exposed when the company has issued a saving type insurance policy with a situation where interest rates might move up and down. Okay, so an insurance company has sold a single premium, a one-time contribution, you see, of 10,000 euro plus admin fees, which means that the policyholder has provided 10,000 euros to be invested and pay something additional to cover the administration fees. Well, the insurer has guaranteed a 3% rate, so it would be invested in the general asset, okay, not in a specific fund, not in a unit, so in the general asset, and the insurer is guarantees 3%, and with a maturity of 10 years, okay? So the capital received is immediately invested in a zero coupon bond at 3.2%. So you know what a zero coupon bond is, okay? It is, I guess you're familiar with this concept of zero coupons. You don't receive anything before maturity. And at maturity, you receive the principal plus all the accumulated, let's say, interest, the accrued interest at maturity after 10 years. And you know why insurers are doing, in this situation, insurer would typically invest in that type of bond. Why? Because it's a way, as you know, a zero coupon bond, you have no risk of reinvestment. Okay, you know exactly what will be the return you get on this bond, okay, which is 3.2, because there is no coupon reinvested, because you don't receive coupon in between. You know, would you have a coupon paid year after year? The problem for the insurer would be to have to reinvest the coupon, and he doesn't know at which rate he would do that. Okay, so by investing in a zero coupon bond, well, you reduce the risk by implicitly, you know that each coupon is reinvested at 3.2%. Okay. So after 1 year, we observe a shift of the yield curve. You know what a yield curve is, indeed. And for the sake of simplicity, I'm assuming here that the yield curve is flat. In other words, the yield curve, whereas it was at 3.2% before, it moved up to 4%. Okay, 4% immediately 1 year after having invested the money. So the first question is, determine the evolution of the policy value for the investor. Okay, because the investor has invested money. So the value of his investment changed year after year because the insurer guarantees 3%. That is, for instance, that you invest 10,000 immediately. 1 year later, how much do you have? 10,000 plus 3%, which means 10,030. Okay. Well, and so on. So this is what we call here the policy value, which we could also call the cash value. Determine the evolution of the capital invested by the insurer and compare with the former. We'll see. And last question, how can you justify a surrender penalty imposed to the policyholder in case of early termination? Well, usually the type of policy includes a penalty in case of, let's say, early termination. And we'll try to understand why. So, in this table, you find the answer to each question. First of all, the policy value. You start with 10,000. Well, 3% of 10,000 indeed is 10,300, okay? Not 10,30 as I said before, 10,300. And you know it moves up year after year. And year 10, you have 13,439, which corresponds to 10,000 invested year after year with an interest of 3% each year. What is the market value of invested funds? You start with 10,000. Then it moves to 9,627. I'm going to tell you why it moved down here. Okay? And because the market value, the problem is that after 1 year, okay, the interest rate moves up to 4%. Okay. So if you look at the year 2, for instance, what is the value of the invested funds? You know exactly how much you are going to get because it's a zero coupon bond. You know what will be the value of this zero coupon bond at year 10. It will be 13,702. Why? Because you know that the rate that applies is 3.2 during 10 years. So the value of this zero coupon bond at maturity is 10,000 times 1 plus 3.2% power 10, okay, which gives you 13,702. But if you look at the value before maturity, because interest rates have moved up, you see now we are going to calculate the market value of the invested funds with the new interest rate, which is 4%. Okay, so if you look at 10,012, where does it come from? How much are you going to get after 1 year, after 10 years? We know the value is 13,702. This is for sure, if you assume there is no failure. Okay, so 13,702 is what you're going to get for sure in 10 years. Not in 10 years exactly, because we are year 2. So there are only 8 years left. So the power will be 10 minus 2, but the discount rate will be the market rate, which is 4% now. So you see 10,012. And for the first number, 9,627, we could have calculated it using 13,702, using 4% at a discount rate, and the power would be 9 rather than 8. Okay? So you see, if you compare, you have a value gap which is created just because of the increase in interest rate. It is typically the problem with what we call the interest rate risk. Okay, the value of the assets decrease if interest rates increase. It has no impact at maturity. If you hold, the bond until maturity, there is no problem. You receive what was expected in the first place, 13,702. The interest movement has no impact because you keep the bond and you just get your money back at maturity. But if you have to sell before maturity, okay, then you may have a loss. You see, up to year 7, you have a loss because the market value of your invested fund is less than the policy value due to the increase in interest rate. Okay, so now we can answer the last question. How can you justify a surrender penalty imposed to the policyholder in case of early termination? You see, there is a risk for the insurer if the policyholder has the possibility to get his money back before maturity because of possible movements of interest rates, and particularly of an upward movement that would decrease the value of the invested funds. Okay? And that is a justification for a penalty if you want to get your money back earlier than maturity. Okay? So implicitly, what does it mean? It means that the policyholder had the option, he has an option to get the surrender value of his policy before the 10-year term. If you have this option, and I use the word option on purpose, okay, it is like an option. You could price it as an option. You have the right to sell, okay, at a price which is the policy value, okay, which might be different from the market value. And this option is an implicit, let's say, return for the policyholder and an implicit cost for the insurer. So you can see the penalty at the price of the option which is offered to the policyholder. Option to terminate the policy earlier than maturity. Okay? So it's just to insist on, it's one aspect of it, to insist on the sensitivity of insurers to interest rate movement. Okay, because when you guarantee rates in particular, okay, you are exposed to the volatility of the market. Okay, and that is a point indeed which we will have to tackle in the next chapter, which has to do with financial management of insurance companies. Okay, the interest rate risk is one of the risks that life insurance companies have to handle carefully. So that was a first exercise to insist on this interest rate risk. Now, let's move to another brief case study, but typical of the situation in which many people are when they reach a certain age, and when they start thinking of their old days, okay? And you guys might believe you are a bit young to think of it. Well, I'm not quite sure about it. You are 45 years. So you are not yet, most of you are not yet there, but it will come soon. And you decide to save to build up a fund you will need at 60 when retiring. In other words, you are 45, but you say, oh my God, in 15 years from now, I will retire. And what about my pension? So maybe I would need to have a bit more, okay? And at 60, your estimated life expectancy is 25 years. So if you look at it, let's assume that based on mortality table, when you reach 60, on average, you can expect to live another 25 years. So you would die at 85. Indeed, you might die earlier or later. But for the insurer, when the insurer will come to price your policy and to handle your policy together with a large number of participants in situations similar to yours, well, he will consider, the insurer, that your expected date of death is 85. Okay? So the question is for you, which amount of capital is needed at 60 if you want 2,000 euro per month until the end of your life? In other words, your objective is to say, well, if I look at my basic pension scheme, it's really not much. So I really need a complement. And ideally, I should be able to get 2,000 euro per month until the end of my life if I want to feel comfortable during my retirement phase. Okay? So you see, if I summarize, you are 45, and you say, well, at 60, I need to have saved enough money so that I can transform this amount of money into an annuity of 2,000 euros per month until the end of my life. For the insurer, it will mean 2,000 euros to be paid to this guy during 25 years on average. Okay? So the question is, how much do you need to save each month before you reach 60? Because there is a first phase between 45 and 60, a first phase during which you will build the fund needed at 60. Okay? So we are assuming that when you save, you can expect a 5% return per year. Okay? Which means 5 over 12% per month. While the annuity rate applied by the insurer, the annuity rate is, let's assume that at 60, you have a certain amount which you have accumulated, that the insurer will manage this money. Okay? And he will manage this money, he will invest it to part of it, and slowly, the fund will decrease because it will take out of this fund enough money to pay the annuity of 2,000 per month, okay, after 60. But part of the money remain invested with the insurer, okay? And this money is invested at 3% yearly rate. So that's the rate per month would be 3 over 12%, okay? Well, and then we'll see what would be the results if you decided to start at 40 or 35. So here, I'm not going to comment these formulas. You are supposed to know that. It's just to remind you that these are the formulas I'm going to use. Just let me tell you what it corresponds to. A is the annuity, the monthly payment. S0 is the amount of money available at a point in time, 0. Okay, and R is the rate, and N is the number of periods. So we just write here, it's a formula that tells you what is the annuity you get for during N period. Okay, if the rate at which the money is invested is R, okay, or if the cost of fund is R, okay. So this is a formula which you've used, for instance, in finance to calculate the monthly payment, for instance, if you borrow money with a sort of lump sum available at the beginning and with a certain number of periods at a certain rate. Indeed, from this formula, you can derive another one which we will use. You can obtain S0, which is just directly transferred from the first one. Okay, so S0 is the amount that would be available now, okay, if you are ready to pay regularly a certain annuity over N period for a rate which is R. Now, a last formula which gives you the amount of money accumulated after N period of time, okay, if you pay an annuity of A, okay, if you contribute for an amount of A monthly, invested at the rate R during N period. You can see that Sn is just equivalent to S0 times 1 plus R power N, indeed, okay? Hence, I can derive this formula from the first one also, or second one. Okay, so these are the three formulas which I'm going to use to solve this problem, which is a typical problem for a potential buyer of a life insurance policy, aiming at a complement for its basic pension scheme revenue. So on this graph, I summarize the problem. You start when you're 45, and there is a first phase, which is a phase up to 60. The first phase, which is a phase of accumulation to constitute a capital, a certain amount S, available when you are 60, so that this amount of capital in the end of the insurer will give the possibility of the insurer to pay you 2,000 per month, okay, during 300 months on average. Indeed, at your personal basis, it may be less than 300 months because you may die earlier, or it may be more because you die later than 85, but the insurer will make a calculation based on the expected date of death in your case. Okay? Well, so the first thing to do, one, is to calculate what is the amount needed to have an annuity of 2,000 per month during 300 months. Okay? So and the second question will be, once we know S, how much do you need to save month after month during the saving phase to constitute, to accumulate this amount S? Okay? So first, what is S? Once we know S, second question, what is the monthly payment, the monthly saving you need to make to accumulate this amount S? So S, the amount of capital available at 60 can be obtained, okay, using one of the formula we had before, actually, okay? S is at the beginning of the period 60-85. So it would be the S0 of the formula before. And S corresponds to the present value of all the future payments, okay? All the future payments of 2,000 each month, taking a rate of 3% per year, which is 0.25 per month, okay, during 300 months. So you find this amount, which is 421,753, okay, which is what is needed at 60 to get 2,000 per month, okay, during 300 months after 60. Okay, so now, if you need to have this, how much do you need to save each month between 45 and 60 to accumulate this amount of 421,753? 753 euro. So the necessary monthly saving before 60 would be M, okay, which is what is the monthly payment needed to get an amount S after 60 during N period at a rate which will be, in this case, 5% per year. In other words, 0.42 if you look at a monthly rate. And you realize that the monthly payment necessary for that would be 1,578 euros, which, you know, may seem rather high and difficult to achieve. It depends how much you earn, indeed. But for the gentleman on the picture here, it seems a bit high. So what's the conclusion of that? The conclusion would be that maybe you should start earlier. And that's why we can try to make the calculation. What would be the situation if you start earlier? If you start saving at 40, the same calculation would be made, except that we would save on a longer period. You know, it would move down. What you need to save monthly is only 1,026. And would you start at 35, you know, it would be only 708 euros. So you see, it just showed that the earlier you start, the easier it is for you to accumulate. Okay, so I just wanted to show you that this type of exercise. Why? Because it's typically what you find if you go on the website of most life insurance companies. They would provide you with the possibility to simulate your own situation. And typically they would ask, well, how much you want to have, what type of annuity you wish, or how much are you ready to save monthly, so that they can make a calculation using these formulas of how much you need to save monthly if you want to have an annuity of that amount, or at which year you should start if you want to accumulate this. So this can be simulated, and most life insurance companies will propose that to their customers. Indeed, the customers have no understanding of how it is calculated. They don't know, they are not specialists like you are, so they don't know all the formulas which we are using here. But you know, it's very simple, but this is a typical calculation that is needed to answer the question of how much should you save, how long will it take, when should you start saving, and so on and so on. Okay, so that's a typical problem of life insurance, which was interesting to discuss, so that you really capture the technicity of all that. Now, next exercise, which is also useful to do. Sometimes it is difficult with the insurers investing your money to really know how much you earn from it. Okay, so the next step will be assessment of the performance of life insurance policy, performance for the policyholders. So here I'm taking another case. So you decide to enter into a saving plan through a life insurance policy, and you would invest in a unit. So it would be a unit-linked life insurance policy, meaning that you contribute year after year 2,000 euro at the beginning of each year. Okay, but you ask your money to be invested in a particular unit which you have selected among different possibilities offered by the insurance company. And you started 3 years ago, and you have here the performance of the unit where your money was invested. Year one, the money invested provided 8% return. The unit provided a 7% return year two, and year three, 6% only. Okay. So when you invest money like this with the insurer needs to cover its basic costs, admin costs and distribution costs and the like. Okay. And which are the loads? What we call administrative loads sometimes. Well, there are usually two types of load. One is based on the premium payments here it's 3.5%, which means that the insurer will take out of your money 3.5% of the premium as admin cost, which means that not all of the money you provide the insurer will be invested. Okay. For instance, if you pay 2,000 at the beginning of each year, there is only 1,970 left because you will pay 3.5% of load on premiums, that is 70 euros. Okay, so 70 euros, which are taken out of the 2,000, so that there is only 1,970 invested. It's not the only load. There is usually also a load for the asset under management, which is what we call the management load. Okay, there is a premium load and a management load. The management load is there to cover the cost of managing the portfolio in which your money is invested. Here it's a much lower rate, 0.4% of assets under management. In other words, the basis to calculate the load is no longer the premium you pay, but the amount of assets in the hand of the insurer and managed for you. Okay, so the so-called concept of AUM, which you are probably familiar with. And at the beginning of each year, okay, the insurer is looking at how much is invested, and he would take out of your contribution 0.4% of that. Tax rule, just make it easy, no taxes on financial income. Okay. So my question is, what is the annual yield at the end of year 3? So you say, Alex, now at the end of year 3, I started 3 years ago. How much did I get from this insurance policy? What is my return on it? So if you have a quick look, most people would say, and most people do it this way. Well, my return is on average 7% because, it moved from 8 to 6. But on average, it's 7%. That's not bad. Indeed, this approach is totally wrong. Okay? Because it doesn't take into account the fact that when you pay 2,000, not all the money is invested. Okay? So let's look at what is the real return if you take into account all these loads. Okay? And the second question will be, what if you consider a 2% penalty if the policyholder wants his money back at the end of the year 3? So if you say, well, I'm not happy with the performance at the end of year 3, I want my money back. You remember, for the reason we have mentioned before, the insurer would usually impose a penalty, which in this case would be 2% penalty to the policyholder, 2% of the asset under management, of the cash value of your policy. So what is the real return on that? So let's look at it. So here I have built a table where we can see all the values year after year during these 3 years. So the first column is capital at the beginning of the year. Okay. There is nothing because you just start. Okay. So the premium paid year 1 is 2,000. Okay. The premium load is 3.5%, so you pay 70. So that the net premium will be 1,930. So when you start not with 2,000, but only 1,930. So the asset under management at the beginning of year 1 is 1,930, which is that just what you have to contribute it to. So, but this is the asset under management when you start. So the insurer will also charge a management load, which is 0.4%. In other words, the insurer will take out again 7.72, which is 0.4% of 1,930. So the net invested is only 1922 1922.28. Okay, so you see, you provided 2,000 to start with, but only 1922.28 is invested. What was the return year 1? 8%. So at the end of year 1, how much do you have? 2,076.06, which is 1922.28 plus 8% of that, which is the return from the unit, and you get 2076.06, which is the capital at the beginning of year 2. Okay? So you have the capital at the beginning of year 2, which is this. You pay a premium again, which is 2,000, but the insurer again will take out the premium load, 70, so that the name premium will still be 1930. So what is the amount of asset under management? So the assets under management now are 4,006.06, because you take what was available at the end of year 1 plus the net additional contribution, which is 1930, so that you have 4,006.06. Okay, which will be the new basis to calculate the new management load, 0.4% of that, which is 16.02. Then the net invested, okay, at the beginning of year 2 will be 3990.04. Okay, this is invested at 7%, so that it produces a capital for the end of the year, which will be 4269.34. So last line is obtained exactly in the same way. You start with a new acquired capital beginning of year 3, which is what was available at the end of year 2. You add a net premium of 1930, so that the new asset under management will be 6199.34. You take out of this 0.4%, so the net invested beginning of year 3 is 6174.54. The return on that is 6%, so that at the end of year 3 you have 6,545.02. This is what you have. In other words, at the end of year 3 you have this amount. Now the question is, what is the average return on my investment? Okay, and I usually ask you to do the job, and I'm always surprised because I see that more than half of the class is not really able to calculate the average annual return. If you pay 2,000 at the beginning of each year, if you get 6,545, what is the average return? So I cannot let you do it because anyway you have the answer on your documents. So let me remind you how we can solve that. You see, if you describe the flows on the time axis, you start by contributing your contributions. You are not looking here at how much is invested. You look at how much you injected. You look at your cash flows. You cash out 2,000 3 times at the beginning of year 1, year 2, and year 3. And at the end of year 3, you have a policy value, which is 6,545.02. Then the question is, what is the yield? So normally you should be able to do so. And indeed, you get it through this formula. You look for R, which for which you have the equivalent of 2,000 invested. The first one have been invested during 3 years. The second payment, 2,000, have been invested during 2 years. So we take power 2. And then the last installment, 2,000 payment, has been invested during 1 year only. So you have power 1 at the end. And the idea is that R should be the rate that makes equivalent the accumulated value here and what you have, 6,545. And if you look at it, it's easy to solve with a spreadsheet, or you even have formula depending on the type of calculator you have. And believe me, you find 441%. So you see, that's what I was telling you. When you look at this case, many people would say, oh, well, the average return is 7% because they invested. The investment is made in a unit that provided on average 7% per year. Okay? But, what you forget when you look at it this way is that not all the money you pay is invested. There are loads which are taken out and therefore the amount invested is less. So if you look at the end, your return is only 441, okay, much less than the average 7% obtained from the unit. Okay, so you may not be happy with this. You will say, well, it's unfair. I thought it was much more than this. So I'm not happy with it. I want to get my money back. Okay, but then you have a penalty of 2%. So if you want to get your penalty, if you want to get your money now, you have a penalty of 2%, which means that the cash value at the end will be 6,545 minus 2%. So the amount left is 6,414.12. And if you made a calculation of the yield with the same formula here, then you find 338%. In other words, you see, you have a return which is about half the average return of the unit if you want to get your money back after 3 years. So that's why some people are not quite happy. Well, actually, they are not happy because they don't really understand the mechanism of the technicality of the policy. Okay, and that's why it is the role usually of intermediaries and agents, for instance, or bankers when the banks are selling this type of product, to explain, to avoid any ambiguity, to explain to the policyholders that the amount invested is not exactly this, and they should give them indication about the real return they should expect. Okay, but indeed, for marketing reasons, sometimes they prefer to focus on the performance of the unit, just forgetting a bit about the cost, the cost for the policyholders to go through an insurance company and to have to pay, which is normal, fees to cover administrative loads. Okay, so you see the performance is much less. That's the conclusion, much less than what you could expect looking at the performance of units. So now we've seen the main technical aspects of these life insurance policies, including a part of saving, the different ways the money could be invested, how to calculate the return, the problem for insurers, particularly if people want to get their money back earlier than maturity. All these points were important. Okay, so now just as a complement, let's take an illustration of the nature of the life insurance policies as opposed to non-life business, And here I'm looking at the income statement of life insurance companies. You're taking the French case, a French report of the Association of Insurers in France. Okay, so what can you see if you look at the year 2017? Okay, first of all, if you look at the income, due to the nature of life insurance, you can see that the financial income represents a much bigger proportion. Here, the financial income, net income from investment, as well as what we call variable insurance adjustments, variable capital insurance adjustment. I don't want to get into the explanation, which corresponds to some specificities of the French system, but these two items corresponds to a kind of element of return on the saving of policyholders. Okay, so you see, it's one third of the total income of insurance comes from financial income. Okay, it's not at all the case in non-life. In non-life, there are also some element of financial income in the income statement, but it is much less than this. Okay, so one third, which demonstrates the financial dimension of the life insurance companies as opposed to non-life insurance companies. Okay. Well, here, profit participation. Well, indeed, financial income are important in the income statement, but part of it is redistributed to policyholders, which is fair enough because the income generated is obtained from the insurance fund, that is, from the money provided by the policyholders. So they get a share of this as a return. And as you can see, profit participation, which is the return, the portion of financial income allocated to policyholders, on average, it is 65%, okay, of the total financial income. Okay, so in other words, about 2/3 of the financial income are redistributed, okay, to the policyholders. 1/3 is kept as a margin for the policy for the insurers themselves. But consider also that part of these gains were also obtained from equity funds. Okay. Well, so if you look at it, it's interesting to compare profit participation and financial income year after year. And you see that there is a much higher volatility in the financial income because the profit participation on average is 65%, okay, of the financial income. But you see that it corresponds to, it's rather flat. Profit participation, you know, it's rather flat. It declined a bit, but not so much. Whereas the financial income is much more volatile. In other words, financial income volatility is mostly absorbed by the company. So you see, it's true that part of the money is kept by the insurance company, but the insurance company also absorbs part of the volatility, which to a certain extent also justify the fact that the return for policyholder be lower than the return for insurance companies. Insurance companies are taking more risk, and therefore they deserve also a good return, a kind of risk premium, which is included in their return. And as you can see, the contribution, what is paid to the policyholders, the profit participation is kind of flat, much less volatile. Okay, so now to conclude with all this part concerning life insurance, I said that it was interesting to look at pension plans also. Pension plans, which corresponds to, well, what we call pension funds, which are types of funds which are managed usually with a much longer maturity. Typically, pension funds would be run, it might be run by a company, for instance, providing a pension scheme for its employees, or it can be externalized. You know, companies might contribute to pension funds managed outside the company, which is, by the way, a better solution. Okay, but with the difference with life insurance, as we have seen it right now, life insurance policy usually have maturity of, let's say, 10, 15 years. Okay, for pension plans, for instance, it would concern people like you, for instance, in their 30s, okay? And they would contribute, you know, all over their working life. So, you know, it means that if you retire, let's assume that you retire at 65, while you are 30, so you have still 35 years of working. And then you may receive an annuity paid until the end of your life. So if you look at it in terms of maturity of the investment, you contribute now, okay, for payments which will take place for you in, let's say, on average, more than 30 years later. So you see, pension funds have maturities which are very long maturities, okay? And they are indeed concerned with long-term investments, okay? And typically they would invest, for instance, in projects that contribute to provide on a long-term basis very secure regular cash flows. They would, for instance, invest in infrastructure when these infrastructures are, you know, not too risky because they benefit from a state guarantee and so on. Okay, so now the problem is how to manage the funds, and the problem is to see what are the risks behind that, because over the last years, and that's why I thought it was useful for you to know a bit about this, that we have seen a series of scandals which now are more or less under control, but still there is a kind of instability in this domain due to kind of misbehavior which have been observed in the past. And that's why a regulation is coming up with more and more strict regulations to avoid situations, the situation we have observed in the past, as we will see. So first of all, there are two types of plans. Okay, you have what we call defined benefit plans. In this case, you might be in a company, for instance, and your company will contribute for a certain amount, and you can also contribute for a certain amount to the pension fund, okay, to accumulate rights for the future, okay? So in the case of defined benefit plans, you know how much you're going to get at the end. For instance, there is a rule established telling exactly how much you're going to earn when you stop working, because it's based on rules which are fixed at the moment when you contribute. Okay? It's different from what we call defined contribution plans. Defined contribution plans, you contribute for a certain amount, you and very often your company, if you have a corporate pension plan. Okay? And you don't know exactly how much you're going to get at the end. It depends on the performance of the investment which have been made with the money you have contributed. Okay? Well, so you see, the first one, defined benefit plans, is much more comfortable for policyholders, for the beneficiaries. Okay? Defined benefits preferred by employees because they know exactly, they know the rules, and they can make a calculation, precise calculation of how much they're going to get when they retire. Okay, so they love it. But indeed, companies are not quite happy with it because it may be risky. Because, you know, if you define clearly how much you pay, you fix your liability. It's become a strict liability for the pension fund. Okay, so, and this strict liability means that you have to make sure that if you have in this defined benefits, there is an implicit return on the money invested. So in case you are unable to achieve your goals in terms of return, well, the fund might be short of money. Okay, so it's employees love it, but it may prove risky for companies, and for that reason, defined contribution, this system is now the dominant system in practice. Okay, because then, you know, defined contributions, you define how much should be paid regularly, but you don't tell how much people are going to receive at the end. Okay, so the liability is not so strict. You have a payment to be made, but the payment will depend on the performance of the fund. So in other words, the risk is transferred to the employee. In one case, the risk is with the pension fund, with the company if it's a corporate pension fund. Okay, in the other case, well, the risk is with the employees. That's why, you know, following a series of difficulties due to the different crises we had on the financial markets in 2000 and there later on in 2007 and so on. Okay, in 2008 and then later on. So following all these bubbles and difficulties have arisen, and now to avoid this, companies tend to say to build up and to propose pension funds which are more based on defined contributions rather than defined benefits. Okay, so let's. I told you that there were a lot of scandals. This document is not quite new, but it illustrates well what I was saying. It was soon after the crisis that took place in 2000. You are too young to remember what occurred at this moment, but if you look at the recent history of the financial market, you would probably realize that you would probably see that 2000 was a tough series of years. And here you have an interesting document which shows the pension deficit, because, you know, the pension scheme was a defined benefit system. Okay, so at the end, there was a certain, for all these corporations with a corporate pension scheme inside, you know, they had a liability which was much in excess, okay, of the assets they had in front of these liabilities to cover these liabilities. For instance, if you take the extreme case, which is Delta Airline, you find here pension deficit as percent of market cap, okay? Excuse me, well, it means that for Delta Airline, the pension deficit was 379 times the market cap of the company. So it's incredible when you see that numbers. And if you look at the deficit in billion, the deficit was 5.66 billion. Okay, Ford Motor, it was 11.69 billion. Okay, General Motors, it was a deficit of 8.64 billion. You see, so huge deficit. Okay, due to the fact that these pension schemes were defined benefits. Okay, and the assets available to cover these were not high enough, hence the deficit. So how could this happen? You will understand with this short illustration. Let's imagine the company is committed to pay a lump sum of 1,000 as pension benefits in 20 years from now. So it's a defined benefits, and that's, for the sake of simplicity, assume that in 20 years, the companies know that 1,000 will have to be paid as pension, let's say, benefits. Okay? What is the amount of the related liability to record in the balance sheet? If you're in this situation, what are you indicate in your balance sheet? What are you going to indicate? And if it's a corporate fund, then you can imagine that you need to have assets as collateral to cover this liability with this pension liability. Okay? So how can you account for that? If you look at the balance sheet of the corporation with a pension fund, okay, you need to write provision for pensions. What is the value today of 1,000 to be paid in 20 years? Okay, and which is the amount of assets, which is indeed normally equivalent to the provisions, to balance the provisions on the liability side. Value of assets held as collateral. To answer this question in terms of principle, indeed, if you take our case, you will take, since you have to pay in 20 years, you are not going to write in your balance sheet 1,000. Okay? Because 1,000 is a sum that will have to be paid in 20 years, and in finance, we know about the time value of money. Okay? There is no reason to record a debt of 1,000 right now, whereas you will have to pay in 10 years. You have to take into account that actually this amount of money will be paid later on, but you have time, and you may have assets in your balance sheet that will be invested to build progressively an amount of capital that will correspond in 20 years to 1,000. Okay? So the question there is, but what should be the discount rate in this calculation? So let's assume that managers in this company are confident in their capacity to obtain a 15% return year after year. You know, in the years, let's say in the late 90s, 90, early 2000, well, you know, the stock market was booming, and 15% was seen as a reasonable rate of return in a portfolio at that time. Today, you would know that this is not necessarily quite reasonable, that it may be a bit optimistic. But let's assume that it was the case, by the way. At that time, those who were managing portfolios, they were kind of sure that they would be able to get 15%. Okay? So if you take 15%, then the amount you need, A, at date T, at any date, before the end, before the maturity of 20 years, will be invested at 15%. In other words, for a particular year, the asset needed to produce 1,000 corresponds to this formula. This asset invested at 5% during the remaining years should produce 1,000. So based on this, we can calculate AT. If you assume 15%, okay, then you have AT, which would be equal to this. Okay, so let's use this formula to calculate the assets year after year needed and the liability. So the liability at maturity is 1,000. Okay. Now the liability book value discounted at the corporate rate that is at 15%. If you look at year zero, 1,000 in 20 years, assuming 15%, gives you 61. 61 invested at 15% during 20 years provide 1,000. Okay. Then, if you look at it for year one, it would be 73. Why? Because the discount rate is still 15%, but the number of years is only 19. And then 18, that's why the value here is growing. Okay. So, and this is the pension asset held. Let's keep away year three for the comments. We comment later on it. So what about the investment return? Let's assume that the first 61 are invested. Well, actually, the portfolio managers, they did better than the 15%. 15% was a kind of reasonable guess, knowing that you would be able to achieve better than this. And they achieved 20%. Okay? So if you achieve 20% on an amount of asset which is 61, okay, you have an investment return which is higher than expected, higher than needed, okay, because the pension asset would move to 73. Because if you add 20% to 61, you find 73. In other words, the pension asset is higher than what is needed, which is 70. 70 is a liability book value. What you need to have in your collateral is the same amount invested. So 73 is above 70. So what can you do? You can take out 3, which is a kind of surplus, which you can allocate to the P&L. Okay? To boost your revenue, to boost the profit and show that, well, that's interesting for managers because they can get bonuses and so on due to their very good performance. Okay? So the adjusted pension asset will be 70, so that the adjusted pension asset is equivalent to the liability book value. What about year 2? You still have 20% return, which is still higher. So then you have 84. How much do you need? 81. Well, actually, so surplus allocated 4. Well, actually, I'm sorry for that, but if would you look at the precise figures, this is a rounding, okay? So the adjusted pension asset will be 81 to fit with the liability. What happened year 3? The bubble burst. Okay, the bubble burst and your investment return is minus 30%. Minus 30%, what does it mean? It means that now the pension asset is 57. Okay, so 57, you need to adjust your pension asset to make sure it will fit with the liability book value, which is 93. So you have to take out of your P&L 36. Then you have a big loss generated. Okay, but you see the problem. If you use a discount rate, which is 15%, which is an optimistic one, due to the willingness of the company to a certain extent to have a low level of liability in the balance sheet, to reduce the amount of debt also in the balance sheet, you know, it's a bit dangerous because in the end, you may not be able to achieve the 15%, and it may be disastrous in terms of impact on the income statement. You see minus 36 for year 3 here. It may be disastrous, and if you have difficulties, if you are below 15%, let's say even 7 or 8% year after year during a period of time, then it may, you know, it may be very difficult to catch up, to compensate, and it may create a kind of situation, well, actually, which is similar to what we had on the slide before, with the big gap between actually the value of asset held by the companies and their liability. So basically, what is wrong there? What is wrong there is to use 15% in this analysis, to use 15% as a kind of discount rate to assess the liability book value. Okay. Now there are regulations that are coming up obliging companies to use a discount rate which is be close to the risk-free rate. Why? Because if there are defined benefits, normally the aim should be to guarantee the payments to the beneficiaries. In other words, you shouldn't take risk with this money when you invest this money. If you don't take risks, then the reasonable discount rate to take into account would be the risk-free rate. That is what you get when you invest without taking risk. So would you take a risk-free rate of, sorry, I didn't indicate how much I took here. I forgot to do that, but I think it's in the range of, maybe I've been using 3%. It's here, yes. So if you use 3%, which is more reasonable, which is closer to the regulation as it is now, then you find a normative liability discounted at the risk-free rate to see which would be much bigger. If you look here 0, rather than 61 in the balance sheet, we should write 554. But you see, it has a huge impact on the balance sheet structure. You know, that's where the ambiguity comes from. Okay, but here we could consider, for instance, if you look at the last column, year 3, that normally in the balance sheet you should have a liability calculated with a risk-free rate which would be 605, whereas the liability book value based on 15% would be 93 only. So you see a big difference, a gap of 512, which corresponds roughly to what you have seen on the slide before for the list of American companies. Okay, so basically to summarize, the problem came from the fact that the liability was essentially calculated with reference to a performance of the fund, which is much higher than what can be reasonably expected without taking risk. You know, the regulations which are introduced now in most countries is to say that these pension funds, when they make the calculation of their liabilities, they should more take a rate which is closer to the risk-free rate. Okay, this is indeed valid essentially for the defined benefits. When you have defined contributions, well, the liability is not fixed. That's another story, and you can use a different approach. Okay, so that's a problem which is more an accounting issue. Okay, why? Because basically these pension schemes may, if they are properly evaluated, may have a huge impact on the balance sheet of the company. Okay, so now what's happened also is that most companies are externalizing the pension fund management. In other words, if they want their employees to benefit from a pension scheme, rather than having inside the company, which to a certain extent expose the employees not only to the risk of losing their job if the companies fail, but also the risk of losing their pension. You know, the better solution now, which is getting more and more common, is to have the pension fund outside the company, managed totally outside. Okay, so first of all, it does not affect the balance sheet of the company. Okay, and second, you know, it's a better guarantee for the employees, because even if the company goes bankrupt, I mean, the money for the pension is held outside the company and managed outside in a specific fund. Well, so that was the brief comment I wanted to make about pension funds. There are pension issues to be dealt with. And I thought it was useful because I'm pretty sure that in Vietnam, this type of funds will also develop a lot, considering the necessity to have solutions for pensions in a country like yours, if you look at the your demographic trend in Vietnam. Okay, it's just we finished just in time, a bit late. Okay, if I'm right for you, it might be close to 10 o'clock. Okay, so I don't say have a good dinner because maybe you had it already. I'm going to have a dinner later on. So see you tomorrow, same time.